CEF stands for Closed-End Fund. A closed-end fund is a type of investment fund that operates in a similar way to a mutual fund or exchange-traded fund, ETF, but with some important differences. Like mutual funds and ETFs, closed-end funds pool together money from investors to invest in a variety of assets, such as stocks, bonds, and real estate. However, unlike mutual funds and ETFs, which are open-ended, meaning they can issue new shares or redeem existing shares at any time, closed-end funds issue a fixed number of shares that are bought and sold on a stock exchange like individual stocks. This means that the value of a closed-end fund's shares is determined by supply and demand on the stock exchange, rather than by the net asset value, NAV, of the fund's underlying investments, as is the case with mutual funds and ETFs. Another key difference between closed-end funds and other types of investment funds is that closed-end funds can use leverage, borrowed money, to increase their returns. While this can increase the potential rewards of a closed-end fund, it also carries additional risks, as losses can be magnified when leverage is used. Overall, closed-end funds can be a valuable addition to a diversified investment portfolio, but investors should carefully consider the risks and potential rewards before investing. But the question that keeps being asked is, are they better than ETFs? There isn't a one-size-fits-all answer to this question, as both closed-end funds and ETFs have their own unique advantages and disadvantages, and the best choice will depend on an individual investor's needs, objectives, and risk tolerance. One potential advantage of closed-end funds is that they may offer the potential for higher yields than ETFs. This is because closed-end funds can use leverage and invest in less liquid assets, which can generate higher returns, but also carry higher risks. Additionally, some closed-end funds may use strategies such as covered call writing, which can generate additional income. On the other hand, ETFs may be more tax-efficient and transparent than closed-end funds, and may offer lower expense ratios. ETFs also typically trade at a price that is close to their underlying net asset value, NAV, while closed-end funds can trade at a discount or a premium to their NAV, depending on market conditions and investor sentiment. Ultimately, the choice between closed-end funds and ETFs will depend on a range of factors, such as an investor's investment objectives, risk tolerance, and tax situation, as well as market conditions and the performance of specific funds. It's important to do your research and consult with a financial advisor to determine which type of fund is right for you.